President Trump says that he will double the current tariffs on foreign steel to 50%.
So this is yet another, punch in the gut, if you will, from the president on the domestic steel industry here in Canada.
President Trump has announced a major policy shift. Steel tariffs will double from 25% to 50%, effective June 4th. The move, revealed during a speech in Pennsylvania with steelworkers, was meant to showcase strength in U.S. manufacturing, but it's also drawn swift backlash from America's closest trading partner. In Canada, industry leaders called it a punch in the gut, warning of job losses and broken supply chains. Meanwhile, U.S. businesses are bracing for price hikes and uncertainty ahead. Let's break down what this means on both sides of the border.
When you have a tariff on foreign companies coming in and dropping their steel in the United States, then there will be upward pressure in prices, even from U.S. domestic companies. And so the companies that need that steel, so like the Ford, Auto, and Coca-Cola, right, Gillette razors, what have you, they're going to have to pay more, even if it's coming from a domestic plant.
On May 30th, President Trump addressed a crowd outside Pittsburgh and confirmed that tariffs on foreign steel would jump to 50% starting June 4th. The announcement coincided with Trump's public endorsement of a $14 billion deal for Japan's Nippon Steel to acquire U.S. steel, a deal he had previously opposed. He now describes it as a partnership rather than a takeover and insists the investment will stay on American soil. You can't take it. What are you going to do? Pick it up and move it to Japan. Trump claims this aligns with his 2024 campaign promises to boost domestic industry and protect U.S. jobs. However, the White House has not released economic modeling or detailed justification for the specific 50% rate. According to CNN reporting, he said he debated 40% but chose 50% without offering a clear explanation. The sudden move has left analysts, manufacturers, and trading partners scrambling to assess its potential fallout. U.S. businesses that depend on steel, automakers, construction firms, appliance makers, are bracing for higher costs. Even if it's coming from a domestic plant, you're going to have to pay more. Professor Tom Smith, Emory University. That's because tariffs not only raise the cost of imports, they also allow domestic producers to increase prices. The result? Broader inflationary pressure on consumer goods, from canned food to cars. Recent government data reflects this concern. According to the Commerce Department, U.S. consumer spending in April rose just 0.2%, a significant drop from 0.7% in March. Analysts attribute the March spike to front-loading, consumers buying early to avoid expected price hikes. Meanwhile, incomes rose by 0.8% in April, driven mainly by Social Security adjustments and labor market strength. The Fed's preferred inflation metric, the Personal Consumption Expenditures PCE index, rose 2.1% year over year, slightly above the 2% target. Economists caution that another wave of input cost inflation could complicate the Federal Reserve's efforts to keep rates steady.
But I think at this point, we now need to put some action into place. It's simply too urgent to ignore.
Canada, America's largest steel trading partner, was blindsided. Catherine Cobden, President, Canadian Steel Producers Association, said, "This is yet another punch in the gut." Canada exports about half of its total steel output to the U.S. Under the new 50% tariff, those shipments may grind to a halt. Cobden warns that the damage goes beyond revenue. It threatens jobs, supply chains, and long-term competitiveness. Even under the previous 25% tariff, Canadian producers lost hundreds of jobs and clients. The latest escalation, Cobden says, could make those losses permanent. The CSPA is urging Prime Minister Mark Carney's government to respond on two fronts: retaliatory trade measures if the tariff is finalized, and stronger border protections to prevent a flood of dumped steel from countries like China, displaced by the U.S. market closure. While Canadian officials have emphasized cooperation with Washington, business leaders are calling for urgent action. A 50% steel tariff may sound like a simple policy shift, but it carries deep ripple effects across industries and borders. As the June 4th deadline approaches, the real question isn't just whether the tariff will stick, but how prepared businesses and governments are to adapt.
The president has said a few times that he was going to speak to President Xi, but he hasn't since before the inauguration. Beijing keeps denying that there was any contact. Do you have anything scheduled?
I believe we'll see something very soon, Margaret.
Steel tariffs have doubled. Trade talks between the U.S. and China are on edge. And a promised call between Trump and Xi still hasn't happened. While headlines focus on tariffs, a deeper economic chess match is unfolding over critical minerals, control of supply chains, and long-term leverage. Let's break down what's really driving the U.S.-China standoff and why steel is just one piece of the puzzle. At the center of the current standoff is a trade agreement signed in Geneva just last month. U.S. officials say China has been slow to issue critical export licenses, particularly for rare minerals, violating the spirit of the deal. President Trump has promised to speak directly with President Xi. But like previous promises, 90 deals in 90 days or weekly calls, this one keeps slipping. Critics call it the taco tariff cycle. Trump always chickens out, where fiery threats are followed by delays or exemptions. Case in point, USTR quietly extended tariff exclusions on Chinese solar equipment until August 31st. Officials call it tactical. Others say it shows strategic inconsistency.
Right. Well, the problem is there's an OECD study, it comes from Paris, that says that because Chinese steel production is something like double the global capacity, that steel industries all across the world are in trouble because of China dumping of steel.
On June 4th, U.S. steel and aluminum tariffs will jump from 25% to 50%. The move is part of Trump's America First policy and follows his speech at a U.S. steel facility in Pennsylvania. According to former National Economic Council Director Kevin Hassett, the new tariffs respond to what the OECD calls a global steel crisis, driven by Chinese overcapacity. China reportedly produces more than twice the world's demand, flooding global markets with underpriced steel and pushing others out. That flood of cheap steel has hurt producers worldwide, including in the US, EU, and Canada. Trump's team argues higher tariffs are needed to protect domestic manufacturing and critical infrastructure. But backlash has come from allies, not China. Canada and Australia argue they're being penalized for a problem they didn't create. Canadian officials warn the tariffs threaten cross-border supply chains under the USMCA. Australia fears losing a major export market. So while the policy targets China's dominance, its ripple effects are straining U.S. trade relationships across allied countries.
Beijing feels like it holds a lot of cards, and one of those key cards is this idea, are critical minerals, rare earths, which are necessary to civilian and military industry here in the U.S. And
while the U.S. raises tariffs, China is playing the long game. Controlling nearly 80% of the world's rare earths, Beijing holds a quiet but powerful advantage. These minerals are essential for everything from electric vehicles to missile systems, and the U.S. depends heavily on them. By slowing exports, China sends a clear message: it won't be cornered. The recent U.S. tariff waiver on solar components? It's a sign that even Washington knows its supply chains aren't fully independent. China is also reshaping its international image, accusing the U.S. of discriminatory trade restrictions and presenting itself as the rational player in global forums. That narrative could gain traction in the global south, where many nations are watching how the two superpowers behave under pressure. Strategically, the U.S. approach looks disjointed. One week it's tough talk, the next quiet concessions. Kevin Hassett says the administration's legal footing is sound, pointing to fallback tools like Section 232, tariffs for national security, and Section 301, penalties for unfair trade. But inconsistent use of these tools adds confusion, even among allies. Trump's repeated claims like 90 deals in 90 days or the long-delayed Xi phone call risk signaling a lack of follow-through rather than strength. By contrast, China looks measured and aligned. That steady posture doesn't make headlines, but it shapes leverage at the negotiating table. With tariffs rising and critical minerals in play, the U.S.-China trade balance is more fragile than ever. Will the Trump-Xi call unlock progress, or just kick the can down the road? For more clear, fact-based insight on global trade, don't forget to like and subscribe. We'll see you in the next breakdown. Thanks for watching.